The US stock market is the financial heart of the nation. It serves as the central hub where the pulse of the American economy can be felt. Every day, millions of shares are traded, billions of dollars change hands, and the fate of companies and investors alike are decided. The stock market is not just a place for buying and selling, it's a dynamic ecosystem that reflects the economic health and future prospects of the country. It's where companies go to raise money. By issuing shares to the public, companies can secure the capital they need to grow, innovate, and expand their operations. The initial public offering, or IPO, is a significant milestone for any company, marking its transition from a private entity to a publicly traded one. This process not only provides companies with the funds they need, but also offers investors a chance to own a piece of the business. It's where investors go to grow their wealth. From individual retail investors to large institutional players, the stock market offers opportunities for everyone to participate in the economic growth of the nation. By buying shares, investors can benefit from the success of the companies they believe in, earning dividends and capital gains. The market is a place of potential prosperity where smart decisions can lead to significant financial rewards. It's a giant scorecard for the American economy. The stock market indexes, such as the Dow Jones Industrial Average and the S&P 500, provide a snapshot of the overall economic performance. These indexes track the performance of a select group of stocks, offering insights into the health of various sectors and the economy as a whole. When the market is up, it often signals investor confidence and economic growth. When it's down, it can indicate economic challenges or uncertainties. From the early days of trading under a buttonwood tree to today's electronic exchanges, the stock market has always been a place of risk and reward. The origins of the stock market can be traced back to the late 18th century, when traders would gather under a buttonwood tree on Wall Street to buy and sell securities. Over the centuries, the market has evolved dramatically, embracing new technologies and expanding its reach globally. Yet, the fundamental principles of risk and reward remain unchanged. The market has experienced incredible growth. From its humble beginnings, the stock market has grown into a complex and sophisticated financial system. Major milestones, such as the introduction of electronic trading and the globalization of financial markets, have transformed the way stocks are traded. This growth has created unprecedented opportunities for investors and companies alike, driving innovation and economic development. But it's also seen its fair share of crashes and corrections. The stock market is inherently volatile, subject to fluctuations driven by economic conditions, geopolitical events, and investor sentiment. Major downturns, such as the Great Depression, Black Monday, and the 2008 financial crisis, have left lasting impacts on the market and the economy. These events serve as reminders of the risks involved in investing and the importance of understanding market dynamics. Understanding the stock market is essential for anyone who wants to be financially savvy. Knowledge of how the market operates, the factors that influence stock prices, and the strategies for investing can empower individuals to make informed financial decisions. Education and awareness are key to navigating the complexities of the market and achieving long-term financial success. Whether you're a seasoned investor or just starting out, knowing how the market works is key to making smart financial decisions. By staying informed and understanding the principles of investing, individuals can build a solid financial foundation and work towards their financial goals. The stock market offers a wealth of opportunities, but it requires diligence, research, and a willingness to learn. So buckle up. We're going on a wild ride through the history, crashes, and future of the US stock market. Join us as we explore the highs and lows, the triumphs and challenges, and the ever-evolving landscape of this fascinating financial world. Whether you're an experienced trader or a curious newcomer, there's always something new to discover in the world of stocks. And the roots of the US stock market can be traced back to 1792, a pivotal year in financial history. A group of 24 stockbrokers gathered under a buttonwood tree on Wall Street in New York City. This unassuming meeting would set the stage for a financial revolution. They signed an agreement that would lay the foundation for the New York Stock Exchange, or NYSE. This agreement, known as the Buttonwood Agreement, was a simple yet profound document. This Buttonwood Agreement marked the beginning of organized securities trading in the United States. It established rules and regulations that would govern trading practices and ensure fair transactions. Early trading was limited to a small number of stocks and bonds. The market was modest, with only a few securities available for trade. Most of these were issued by the government and a handful of established companies. Government bonds were particularly popular, providing a secure investment option. As the young nation grew, so did its need for capital. The burgeoning economy required funds to support infrastructure projects, businesses, and new ventures. The stock market provided a mechanism for businesses to raise funds by issuing shares of stock to the public. This allowed companies to expand and innovate, driving economic progress. This fueled economic expansion and industrial growth. The stock market became a vital component of the American economy, facilitating the flow of capital and fostering a spirit of entrepreneurship. Over time, the NYSE grew in size and influence, attracting more investors and companies. It evolved into a bustling hub of financial activity, reflecting the dynamic nature of the American economy. Today, the New York Stock Exchange stands as a symbol of financial power and innovation, its roots deeply embedded in the early days of American history. The New York Stock Exchange, established in 1817, became the preeminent stock exchange in the US. It's known for its physical trading floor and iconic opening bell. The NYSE lists many of the world's largest and most established companies. In 1971, the NASDAQ stock market emerged as a competitor to the NYSE. NASDAQ was the world's first electronic stock market. It provided a platform for younger, technology-focused companies to go public. The competition between the NYSE and NASDAQ fostered innovation and efficiency in the market. Both exchanges have played a crucial role in shaping the modern financial landscape. Section 4: Black Days on Wall Street, the crashes that shook the world. Throughout history, the stock market has experienced several significant crashes that have left an indelible mark on the financial world. The stock market is not immune to crashes. These dramatic downturns can send shockwaves through the global economy, affecting not just investors but everyday people as well. These events can be triggered by a variety of factors, including speculative bubbles, economic recessions, and unexpected events. Speculative bubbles occur when asset prices are driven to unsustainable levels by investor behavior, often fueled by irrational exuberance. Understanding these crashes is crucial to understanding the risks and opportunities of the market. By studying past crashes, investors can learn valuable lessons about market behavior and the importance of risk management. The crash of 1929. This catastrophic crash marked the beginning of the Great Depression, a period of severe economic hardship that lasted for over a decade. This catastrophic crash marked the beginning of the Great Depression. The impact was felt worldwide, leading to widespread unemployment, poverty, and a significant decline in industrial production. Years of speculation and excessive borrowing culminated in a massive sell-off that wiped out billions of dollars in wealth. Black Monday, 1987. This event was another stark reminder of the volatility of financial markets. On October 19, 1987, the Dow Jones Industrial Average plunged over 22% in a single day. This unprecedented drop was the largest one-day percentage decline in the stock market's history. This crash, attributed to program trading and market psychology, highlighted the interconnectedness of global markets. The rapid sell-off was exacerbated by computerized trading systems that automatically executed large sell orders. The financial crisis of 2008. This crisis was one of the most severe since the Great Depression, with far-reaching consequences for the global economy. This crisis was triggered by the collapse of the subprime mortgage market. The housing bubble burst, leading to a wave of foreclosures and a sharp decline in housing prices. It led to the failure of major financial institutions and a severe global recession. The collapse of Lehman Brothers, a major investment bank, sent shockwaves through the financial system, leading to a credit crunch and a deep economic downturn. Each of these crashes led to significant regulatory reforms aimed at preventing future crises and restoring investor confidence. The aftermath of these events saw the implementation of new financial regulations designed to increase transparency, reduce risk, and protect investors. Section 5. The People's Market Technology opens the door. The rise of the internet and mobile technology has democratized access to the stock market. Online brokerage platforms have made it easier than ever for individual investors to buy and sell stocks. Discount brokers and robo-advisors have emerged, offering low-cost trading and automated investment management. This has empowered a new generation of investors to take control of their financial futures. Social media and online forums have also played a role in shaping market sentiment. The rise of meme stocks and the influence of retail investors demonstrate the evolving dynamics of the market. Section 6. When markets crash, Main Street feels the pain. Stock market crashes can have a ripple effect throughout the economy when stock prices and bailouts. Section 7. The future of the market. Innovation and uncertainty. The US stock market is constantly evolving. New technologies such as artificial intelligence and blockchain are poised to transform the way we trade and invest. The rise of passive investing through index funds and exchange-traded funds is challenging traditional active management. Sustainability and ESG, or environmental, social and governance factors, are increasingly influencing investment decisions. Geopolitical events, economic uncertainty and technological disruption will continue to shape the market landscape. Navigating this complex and ever-changing environment requires investors to stay informed, adapt to new trends and manage risk effectively.